The New Zealand company I have chosen is Hallenstein Glasson Holdings Limited, which will be referred as HGL. HGL is consisted of two companies, Hallenstein Brothers and Glassons. Hallenstein Brothers is a New Zealand-based men's fashion retail store. It sells the latest clothing, suits, shoes, and accessories for men in both Australia and New Zealand, and also online. Glassons is a women's fashion store selling the latest and trending clothing such as jeans, dresses, knitwear, and also blouses. It has stores throughout New Zealand and Australia, and they also sell online and ship worldwide. Why is HGL audited? Annual audits are required for FMC companies, and HGL can be considered an FMC reporting entity as it is listed on the New Zealand Stock Exchange. A company can be identified as an FMC reporting entity if it is a listed company, an issuer, a bank, or an insurance company. Companies are also audited to make the financial statements credible and more reliable. They are audited to validate assertions made by management and to ensure that economic events are communicated to the users appropriately. The company is audited for the relevant stakeholders such as current shareholders, employees, creditors, and many more. An inherent risk is the risk of a material misstatement in a company's financial statements without considering internal controls. It is derived from the nature of the business transaction or operation without the implementation of internal controls to mitigate the risk. It's the risk inherent in a business process or activity before the company implements any processes to reduce the risk. The first major inherent risk of HGL is the state of economy due to the closure of all HGL stores due to COVID-19. The second major inherent risk of HGL is the susceptibility to fraud and theft of inventory and cash, as all retail stores were closed for a significant amount of time, which opens up the door to higher risks of theft and fraud. The third major inherent risk of HGL is the complexity of overseas trade. HGL trades overseas as they purchase their inventory from overseas suppliers. This means that HGL would have a foreign currency translation reserve, which is a very complex transaction and could potentially lead to errors on the HGL's financial statements when translating from the foreign currency to the home currency. A control risk arises because a business does not have adequate internal control in place to prevent and detect material misstatements due to errors or fraud. It's the risk of failure in a company's internal control system. A control risk for HGL is lowering their planned stock intake, meaning purchasing lower levels of stock than planned due to the losing sales because of COVID-19. This also means that HGL stores would have obsolete inventory, which leads to the second control risk, which is storage of inventory. The inventory may become damaged or stolen during the lockdown period. The third control risk is HGL using forward exchange contracts to hedge its foreign exchange risk arising from future purchases. The audit implications of the risks identified are: firstly, the risks in levels of inventory will challenge assertions of accuracy and completeness. Are the amount of inventories and the value of them correctly calculated? And are the inventories recorded completely? Secondly, the risks in storage of inventory will challenge assertions of valuation and existence. Does the inventory balance truly reflect its economic value? And does the inventory balances reported in the financial statements actually exist at the reporting date? And lastly, the risks in foreign currency translation reserve will challenge assertions of accuracy and completeness. Is the amount and value of the foreign currency translation reserve correctly calculated? And has it been recorded completely? The overall conclusion regarding risk on a continuum from low through medium to high risk, HGL has a medium overall risk. HGL has a high inherent risk due to the company struggling because of the COVID-19 situation, but the control systems are strong as the company has a risk management strategy and also maintains a risk framework, which identifies and seeks to manage risk throughout the HGL group. HGL also has a treasury risk policy to manage the foreign exchange risk. It uses foreign exchange contracts with major retail banks to hedge its foreign exchange risk arising from future purchases. This means that HGL has low control risks. Thus, there is a medium detection risk overall as the controls offset the high inherent risk. The item I have chosen to be audited is inventory. The reason I chose inventory was because it's the main source of income for HGL and the main business of Hallenstein and Glasson. The balance of inventory as at 1st August 2019 was over $24 million. Inventory makes up nearly 50% of HGL's current assets, and thus it is very significant to HGL. The overall approach is to use the lower assessed level of control risk. This approach allows the auditor to obtain some evidence from testing controls, followed by reduced levels of substantive testing. This is because HGL already has effective internal controls in place, and the audit plans to test those controls. This will reduce control risk, and thus the auditor must perform tests of control to obtain evidence to support level. The first specific procedure is the observation of the physical inventory count. This would be when you are actually attending the physical count of the inventory to see whether the inventory on the balance sheet actually exists and whether the inventory transactions actually took place. You can ask about their inventory counting procedure, observe counts as they are being done, test count some of the inventory yourself, and trace your counts to the amounts recorded by HGL's counters, and verify that all inventory count tags were accounted for. You can test the inventory in other locations where there are significant amounts of inventory. Therefore, physical verification is one of the procedures to confirm the existence assertion. The second specific procedure is the valuation of inventory. The valuation assertion examines whether HGL's inventory balance is correct, and the evaluation method used by HGL in determining the cost of inventory is appropriate. The value of inventory is measured at the lower of cost and net realizable value. You would want to make sure that HGL is using this correctly to avoid misstatements. You would want to check HGL's inventory valuation by calculating it again, ask related people about the existence of obsolete inventory, check if the obsolete inventory is properly presented, check if it has been separated from other inventories, and check if the cost of the obsolete inventory value is valued down to the market value. In conclusion, HGL has a high inherent risk due to the COVID-19 situation. It has a strong risk management strategy and maintains a risk framework, thus low control risk. It should use the lower assessed level of control risk audit strategy to audit its inventory, where they observe inventory and make sure it's being valued correctly.